Okay, folks, I think can you hear me? No? Okay, that's about as loud as it's going to get. So if you guys don't, if you guys stop talking, maybe we can check the volume out. Welcome. What class do you think you're in? Let's make sure we're in the right class, right? This is corporate finance. As I was walking down, no, actually, I took the elevator down. I walk up, I take the elevator down. Weird process, and I'll talk about why. Um, I remember a day in 1984. It was September of 1984. I walked into a class at UC Berkeley, and it was my very first class teaching. It was a corporate finance class. So you know you're getting old when you run into the kids of the people you used to teach. Grandkids, I think I have to draw the line. I haven't gotten there yet. But this is my 40th year teaching this class. And I'll tell you so. No. This is, I don't want to pin and I want, the reason I say that is you also know I teach a valuation class. And your classes are like your kids. You're not supposed to pick favorites. I do it all the time with my kids. They shift on a day-to-day basis. But this is my favorite class to teach. I think, and as you go through, you'll see why. This is a class that I think everybody should take. Doesn't matter whether you're marketing, a literature major, you're an entrepreneur, you're a VC, you know. And I know you've got preconceptions of what a corporate finance class is. And at the end of today, maybe those preconceptions can be set to rest. Okay. So let me get very quickly out of the logistics part of this class, and then we can start talking about corporate finance. In terms of logistics, you can find me. I mean, there are three. The problem with this building is actually 3 buildings. So I've got to tell you which building I'm in. I'm in KMEC 969. That's my office. If you know, you can all, if it doesn't even have to be office hours. If I'm there, you can knock and come on in. My email address is there. That's probably the easiest and most timely way to get to me. I will have office hours right after this class. Now, I teach 3 classes today. This class, then I teach 1:30. I teach the MBA valuation class, and at 3:30, I teach the undergraduate valuation class. You're feeling sorry for me, right? I do it on Monday and Wednesday for 14 weeks. Then I'm done for the rest of the year. 38 weeks of doing nothing. So, so don't feel sorry for me. 3 classes today, but it basically means Mondays are going to be packed. But, I will also, it says all office hours will be online, but that's not true. So come in. I will also put it on Zoom for those of you who might not be able to physically be there. But I'd really, really like to see you in person. Otherwise, what's the point, right? I mean, this is in 2020 where you have no choice but to do it online. There are 2 TAs for the class. Lambert and Jose both took this class last year. They know exactly how much I torture people during the class. They've experienced the torture. They know this class from the inside out. They will reach out to you with their office hours and a review session each week. The review session would really be to work through problems from past quizzes, because I will not work through problems in class. That's not the point of the class. But those review sessions, for those of you who want to get, feel a little shaky on your mechanics, hopefully those review sessions will help. I sent you how many of you have not been receiving my emails? How many of you have been receiving my emails but not reading them? Come on, be honest, right? They're really long, right? And you look at it and say, we live in an age of text messages. Emails sounds primitive. But with Twitter, you can have 3-page tweets. I can have 3-page emails. So you've had 3 emails so far. You can count. And you can find all those emails, and I'll tell you where you can find the emails if you haven't got them, and obviously you all have. So in one of the first emails, I talked about what I'd like you to bring into this class. It's a little too late for preseason. Maybe it's not. You can still catch up over the weekend. There are three basic skill sets you need for corporate finance. First is accounting. I would say some terrible things about accountants over the course of the semester, and I mean every word of it. Okay. But the truth is, the language of finance and business is accounting. Not accounting as in debit credit. I frankly couldn't care less, but being able to read a financial statement. If you don't know the difference between operating income and net income, pause right there. Do you? If you don't, then I don't care if you've taken an accounting class, it's not stuck. So about 3 years ago, I decided to create my own version of an accounting class, which an accounting professor would blanch at because I break accounting rules left and right. But it's a class that's in service of this corporate finance class. It's about knowing enough accounting that if I gave you the Tesla 10K from last year, you will go through it and at least be able to make sense of what happened last year. So that's the first skill set. Do you know enough accounting to read financial statements? Well, it's a 12-session class. It's about 3 hours. So if you feel your accounting is shaky, do it. If not, just skip it. Now, the second is statistics. If I ask you what the point of statistics is, besides torturing generations of college students by making you take the class, what's the point of statistics? What, anybody want to give that a shot? What does statistics help you do? Not just condense, but make sense of, right? Because the problem with data is it's often contradictory. It pulls you in different directions, and you have to say, how do I make sense of data that's pulling me in different directions? Statistics is designed for the world we live in. Why? Because we live in the big data world, right? We're drowning in data. Nobody should be complaining anymore that they don't have enough information. We have too much stuff coming at us, and statistics is the perfect discipline to make sense of the data. Again, the unfortunate truth is the way we're taught statistics is designed to make sure we never want to do statistics again for the rest of our lives, which is unfortunate because it's abstract and it has silly questions to which you already know the answer, like, is there a relationship between how much you eat and how much you weigh? Yes. But you could do a statistics analysis to back it up and say, what's the point? But again, I 2 years ago, I created a compressed class because, I want you to know enough statistics to make sense of the data that's going to come at you. And you're going to have too much data. So you got accounting, you got statistics. And of course, you've taken a foundation. How many of you are taking foundations while you're taking this class? Because you're allowed to do that as an MBA, okay? How many of you have taken foundations already? I assume the rest of you were able to waive out. Can you waive out of foundations? I'm not sure. But if you think about foundations of finance, there are a few fundamental financial skills I need to bring in the class. Here's the first one. Do any of you know the terms of the Shohei Ohtani contract with the Los Angeles Dodgers? Just give me the top number. Somebody should have read the top number. What's the top number of the contract, the value of the contract, at least what you saw in the news stories? $700 million. Impressive. It's over 10 years. So when I say 700 million over 10 years, your mind says that's 70 million a year. But that's not the way that contract is structured. Somebody help me out here. What's the Ohtani contract structured as? But what is he making every year for the next 10 years? 2 million a year for 10 years and $680 million at the end of year 10 or around year 10. Now, when you have a $700 million contract, that's a lot of money. So I'm not going to nitpick this. But the value of that contract might be less than a $450 million contract that another player might sign where he gets paid or she gets paid, $50 million for the next 9 years. That's a present value. It's amazing how much of finance is present value. Hopefully you come out of foundations with enough grasp of present value that if I give you a set of cash flows and a discount rate, you're not wrestling with them, right? If nothing else, the present value button in your calculator should be working for you rather than the other way around. But basically, from foundations, I want you to bring in time value of money. Hopefully, coming into this class, you know the difference between a bond and a stock, at least in generic terms. Hopefully, coming into this class, you have at least the outlines of what makes an option an option. Somebody help me out. What makes an option an option? What makes options different from almost any other cash flow generating asset? This means foundations, right? What is it about options that makes them unique? There are lots of things that depend on the stock depends on the value of another bond depends on the, so it's more than that. It depends on the value of another asset. It's a right, but basically, if you think in terms of cash flows, what makes an option unique? Do you want me to give it in terms of cash flows? There's a kink in the cash flows, right? Basically, what it is, you know, you've got limited downside, unlimited upside, potentially. That's what, it's a contingent cash flow. Something has to happen. Now, of course, you know, even if you don't remember option pricing, if you remember that options are contingent cash flows, that's what the right allows you to do. You don't have to buy the stock if it's not in your best interest. If you buy a call option, that's all I need. I don't need much coming in, but if you feel shaky about any of those three skills, try one of those mini courses. It'll cost you absolutely nothing, but just to get up to speed so when we start talking about corporate finance, you're not digging yourself out of what exactly is operating income again. Now, you might have already been told, or you will be told, I will harass you for the next 15 weeks. Here's my promise. You will get an email from me every single day. Let me take that back. There will be a week in March where I will not send you an email. And I have to wrestle with myself. Can I? No. But barring those 7 days, you'll hear from me every single day. And here's how it'll go. After class today, Monday, you'll get an email from me. What will it do? It'll tell you what we did in class today. You're saying, but I was there. You might have been here physically, but mentally you might have taken a little break. This is what we did in class today, folks. And perhaps giving you a couple of links on things that build off the class. Tomorrow, you'll get an email from me on what I call the corporate finance puzzle of the week. You say, what the heck is that? I have no idea. Week to week, you know, we'll think of something that's happening in markets out there, and I'll throw it out here and say, take the corporate finance we've learned so far and apply it to this and tell me how you would approach this particular news story or this particular data point. On Wednesday, again, you have class, you'll have a follow-up. On Thursday, I'll send you an email nagging you about the project. You say, what project? You're already doing a project. You don't even know it yet. But about 10 minutes from now, I'll tell you what the project is. But it's going to run through the entire semester. It's due on the very last day of class. There's nothing due until then. And I know exactly what's going to happen. You're going to put it off, and you're going to put it off, and you're going to put it off. And sometime in the 14th week, you're going to go, oh my God, there's a project due next week. So you know what I'm going to do? Every week, I'm going to send you a timeline on where you're supposed to be on the project, knowing fully well that you're nowhere close. What I'm trying to evoke is enough guilt in this process. Oh my God, maybe I should do the project. So every Thursday, you'll get a reminder on how far behind you're in the project. If you're easily stressed out or anxious, I'm sorry, because I will add to that stress if you don't keep up. On Friday, I'll send you an in-practice webcast. What is that? Often in corporate finance valuation, we talk about things, and it sounds easy when you talk about it, but until you get your hands dirty, you really don't, you don't get it. So we might talk about debt ratios in class, and I'll do it for a company, and saying that looked easy. In the in-practice webcast, I will take a real company. I will take the annual report, say, this is where I went to get the debt number. This is how I got the equity number. This is not elaborate theory. It's not, deep stuff. It's about applying what we do in class to real companies and saying, this is a process you can use. On Saturday, you get a weekly newsletter. Not much news, but one of the problems being in a class this big is it's easy to get lost, especially as you get to week 6, week 7, life catches up with you, other classes up. So the weekly newsletter is like a GPS. It says, this is where we're going. This is where we are. So we're on page 135 of Lecture Note Packet 1. So there's not much deep in there, but basically it'll reflect on what we did the previous week and tell you where we are now and where we're going in the next week. On Sunday, I'll give you a preview of what's coming the next week. So basically, get ready. Your first email. If you want to block me, go ahead, but that's fine. I really don't care. I'm going to send you the email anyway. So, I would suggest creating a, if you have a Mac, you can create a smart mailbox so they all go there because, you might want to look back and say, when was this project due again? What's involved this week? Now, in terms of class notes, now I would like you to be here in person. I'm not going to take attendance, but I'd really like you to be here. But I am a pragmatist. I know that over the course of the next 15 weeks, you'll have other stuff. Like what? I mean, let's face it. The only reason you come back for an MBA is not develop your intellectual toolkit, but it's mercenary. This is not a master's in history where you're dancing around intellectual stuff. You're saying, how will this improve my standing in life? And if you're paying $200,000, which some of you are, or many of you are, I completely understand. So if there is an interview, you have to go to someplace, you got to travel for your summer internship to get, that's fine. And that's why I will Zoom every class and record it. But please don't make this a Zoom class. You're paying too much for it. The whole point of this class is to be here, to interact, to have that learning that comes from being around other people. The only thing you have to bring to class is the lecture note packet. I sent a link to it, download it. I don't want to be responsible for forests disappearing in Brazil. So if you don't have to print it, don't print it. You can look at it in your iPad. You can make notes on it as you go through. But every slide you will see is going to be in that packet. There are no surprises here. You can download the packet either in PDF format, which is, more forgiving of different systems, or in PowerPoint. And I'll warn you, I make my PowerPoint on a Mac. For some reason, Microsoft seems to have trouble when you have an IBM and your PowerPoint and it reads a Mac PowerPoint. Don't ask me why, it frustrates me. So when you if you decide to download this PowerPoint, the advantage is you get the notes page with it as well, and you can see the notes for each slide. But it might say you might have to repair this PowerPoint. Just go ahead and just repair it. Nothing bad will happen. There's no virus lurking in there. So you can download whichever version you want. Okay? There are 2 packets. The first packet will cover sessions 1 through 15, the second packet from session 16 through 26. So make sure, when we get closer to that, I'll remind you that the second packet it has to be downloaded. And as I said, there's no excuse for saying, I wasn't in class, I don't know what was happening. Because every class, as I said, will be recorded. There'll be not just a Zoom link to it, but I also will put it on YouTube. The advantage of YouTube is twofold. One is it's very forgiving of broadband. So if you're sitting at an airport and you've got your cell phone as your Wi-Fi, as your connector to the broadband, YouTube will adjust the size of so you can do it pretty much everywhere. You can even use, I've never tried it on airplane Wi-Fi, which is, I think, the definition of horrifically bad Wi-Fi to begin with. But I think even on airplane Wi-Fi, you could. So every class will be recorded. And that's not all. I know there's this bright space thing. This is the seventh learning management system that NYU has used in the last 40 years. I've never used any of them because they're all closed systems. You have to be an NYU student, and I hate closed systems. It just viscerally, I'm against it. So everything you need so I've opened up a Brightspace page because I'm supposed to. I put whatever I wanted to last week. I'm never going to visit it again for the next 15 weeks. I think the Zoom recordings might show up automatically there, but I don't even know that because I've never checked. The only reason the Brightspace is going to be used for your grades, so you can see, you can see the recordings as they go along. Everything for this class is in the web page for this class. And again, I've sent you the link. Click on the link so you can see, all of the different pieces of the class. The YouTube channel is where all the class will be carried. And every email I send you, I will put into what I call the email chronicles. Nothing fancier, but so you can go back and see by date every email. Again, my job is to take away every conceivable excuse you might have. So I didn't know that was happening. There will be no excuse because even if you miss an email, it's in here. You've seen the Google Calendar. Check on the quiz dates because there are 3 quizzes in a final exam. The dates are set. I have a blog. I sent you my 4th data update I put up yesterday. So there's nothing fancy in this blog. It's not for theory. It's basically, the first 4 data updates are about what I've seen in the data in 2023. They're all finance related posts. Basically, they're very related to what you will be doing in this class. So I think they actually will tell you how long it takes you to read the blog. It's in 11 minutes. Now, it might be worth your time to take the 11 minutes and keep up, even though you're just starting the class, because much of what's coming in the class. I do have an X, I guess I should call it, a Twitter feed. I tweet very, very rarely, and the one thing I will tell you is actually a couple of students last year tried to tweet me questions about the class, and I can guarantee you I will not tweet you answers about the questions. Okay. I only tweet. I don't even know whether that's the right word. It sounds like I'm a bird, but I only tweet on things if I put up a blog post. It's a great way to draw people to something more substantial. Is the way I think about Twitter, right? And I follow only 3 people. You think it must be Warren Buffett. The 3 people all have my same last name. They're 3 of my 4 kids. I actually requested all 4. My daughter has absolutely refused. 7 years that request has been hanging out there. So this is a way of saying, Dad, I will never follow. So basically, I follow only 3 people. So as you can see, I'm not an active. In terms of material, as I said, the lecture notes are the only absolutely required material. There is a book, which is my book, which actually mirrors the class. I couldn't tell you where the class ends and the book begins because the book actually came out of the class, and the class it's the last edition is 2013. The publisher wants me to do a new edition. One of these days I'll do it. But in the class, I will update you. But it's an applied corporate finance book. It's obscenely overpriced. How overpriced? I think after I wrote the book, the publisher offered to send me 10 copies at a 40% discount. I said yes. And then they send me a bill for 10 copies for $800. And I said, that's 40% off? They said, yeah, it's normally $140. It's not a hard bound book. It's actually a paper. So if you can find it cheap somewhere, I'm not supposed to say there's a publisher. If you go, there's an Asian edition probably that's much, much, much cheaper. This is one thing publishers seem to think it's still 1985. They have a Canadian edition and a US edition. The stupidity of doing this strikes me. Yeah? So I have absolutely no qualms about you finding the cheapest version of this book somewhere and getting it. Because for those of you for whom the lecture notes don't do it, the book can be a useful companion. There are practice problems that you can find for every section. But more critically, every quiz and exam I've ever given a corporate finance class is on my website. So that's 40 years of quizzes and exams. Hey. The quiz and exam you will be taking is open book, open notes. Okay. So you have lots of practice if you want it. Obviously, your time constraints, you can't do for all 40 years, but you can pick and choose. I'll give you suggestions on how you can get through them. And during the course of this class, I'll talk about data that I use in corporate finance. Much of the data I generate by looking at publicly traded companies around the world at the start of every year, so you can find the data. And for some of the stuff, I will use spreadsheets as tools. Let me be very clear. Excel is your tool. You're not Excel's tool. So basically, the spreadsheets are there as a tool. And the only reason I build these spreadsheets and give them to you is because I don't want you to spend the next 15 weeks trying to master Excel. That's not the point of this class. There's nothing magical about these spreadsheets. I'll make sure they're not black boxes. But as we go through this class, you can download the spreadsheets for the class if you need them as tools. So now let's get to corporate finance. How many of you have taken a corporate finance class in a prior life? You've taken, so if I ask you what, so don't look at this, if I asked you what your corporate finance class was about, how would you describe it? What was it? That's not a good start, right? It's been a while. It's usually a precursor to, I don't remember anything about the class, but hopefully you remember enough to, so what was the class about? The next level. What was the first level? Okay, but we're in corporate finance, and what did you look at beyond the time value of money? Okay. So that actually is one of the problems with corporate finance classes. They're not particularly memorable, right? Right. Anybody else want to give me a shot, even if you've not? What do you think? I mean, you've heard the word corporate finance thrown around in the context of banking, in the context of companies. What do you think corporate finance is? Yeah.
Say, cost of capital.
Cost of capital, okay. So cost of debt, cost of capital, it's a hurdle rate. In fact, one of the problems of teaching this class in New York is the investment banking version of corporate finance kind of comes into play, right? Every investment bank has a corporate finance department. Now, what investment bankers call, yeah, go ahead.
Like when you start a startup, until a certain point, you just keep burning your own gas. After you want to scale up to an extent.
That's when you need corporate finance. Not when you're burning through, but after you've burned through the cash, right? By then it's a sunk cost, right? Nothing you can do about it.
When you're there.
Okay, so this is the interaction with outsiders to bring in capital. Actually, that's very close to how investment bankers think about corporate finance. Investment banking, corporate finance is about the interaction between firms and outside investors, public markets, private markets. That's what. But that's like a podiatrist claiming to be a general practitioner. It's a very small slice of corporate finance. I'll give you my definition of corporate finance. It's incredibly self-serving. You know what corporate finance covers? Any decision that involves the use of money. Have you ever made a decision that doesn't involve the use of money? Yeah, in your personal lives, you might. But in your professional lives, almost everything you do requires either you getting money or you paying money, right? You know why this is so self-serving? Every one of you has been working in corporate finance without knowing it. No matter what your job was before. Marketing, even strategy, another group for which I would say some terrible things. I mean, whatever your job was, you were paid, presumably. There was a paycheck, and presumably you were doing something to the company other than just costing it money, right? Everything is corporate finance. Did you guys have to go through that 2 weeks before this program started where I call this the brainwashing weeks, where they bring you in, like in August to September, just before class, did you have to come in? You don't have to anymore? Thank God. You do still? Because that's when they bring you in and tell you everything you've learned so far in your life is useless. And now you're going to learn the profound stuff. Complete lie. But they've got to do it, right? They've got to set you up to make you feel better about spending $200,000. And this is their way of doing it. About 10 years ago, they made the mistake of inviting me to come in and talk to the incoming MBA group. Why? Because I've been teaching corporate finance in the first year of the program, pretty much every year going back to, and I would say about 60 to 70% of all full-time MBAs end up going through the program. So many of them will be taking a class. Why don't you come in and tell them what your class is about? So I came in with a flow chart and I said, this is the only class that really matters. And I truly believe that everything else you're going to be doing in the MBA program is in service of my class. That accounting class is to provide me raw data, then go away. The marketing class is so that I can estimate a margin for your business, then go. Everything you do in this program is in service of this class because this is the ultimate big picture class. Because you're talking about every decision that involves the use of money. You're not talking about a slice of a business, everything in a business. If you ask me to describe this class, I describe it as a big picture and applied class. And I'll be very specific about that, why I call it a big picture class. But I'm going to give away what I hope you will take out of the class. In the very last session, I'm going to bring these out and I'm going to ask you, did we advance towards my objectives? So these are my objectives for what I hope you get out of this class. First, I want to give you corporate finance tools that you can apply on real companies. In fact, when I first started teaching corporate finance in 1984, they gave me a syllabus that the other people had used. And initially, the first year, I taught out of the syllabus. And I very quickly realized we were talking about things that nobody really cared about, that had made their way into that syllabus, either stayed on with inertia or because people in business schools thought that had to be taught. So very early in this process, I start crossing out topics. Because my question is, can it be applied? If the answer is no, I'm not going to talk about it. I have no interest in talking about things that are not applied. So at the end of this class, I'm going to ask you, do you have the tools and can you apply the tools? Not just do you understand the tools, but can you use them? So that's the first objective. Second, as I said, this is a big picture class. In other words, we'll be talking about small pieces. And as we talk about a piece, you can get lost in it. So we might talk about how to measure risk and bring into hurdle rates. And you might feel a little lost. But I'm going to constantly pull you up. I call this elevation and say, this is where it fits in the big picture. This is why we're doing it. And this is why it matters. So I want you to be able to apply things. I want you to see the big picture. And there's a third objective that's going to sound a little sick, but give me a chance. I hope you find corporate finance as much fun as I do. I know it sounds sick, but corporate finance is like a puzzle. And once you start to make sense of it, it's amazing how much it opens up how you think about everything that's happening around you. So I've asked you, how much does Taylor Swift add to the NFL's value? You will have the tools to actually be able to address that question. Every story you read has a corporate finance subtext, including the Shohei Ohtani story. So as you start to get the first principles, you will be able, I call these aha moments, with things that did not, buybacks. Why are companies buying back so much stock? So that's the fun part of corporate finance is as you do the work of understanding the first principles, you start to make sense of the world around you. So I know every class you go in, they claim it's a big picture class. You say, yeah, right. So I'm going to show you the big picture of corporate finance. But before I do that, I want to first break a mindset you might have already gotten into. How many of you are accountants? Nobody wants to admit to it? CPA? Yeah. CA. Okay. I am sorry, but no, somebody has to do the dirty work, I guess. But accounting is a key ingredient in business. They have a place in business. But many of you, if the first, and how many of you come from liberal arts backgrounds? Okay. So your first exposure to the numbers part of business is probably the accounting class after a long time, right? So I want to take you out of the accounting mindset. To understand the accounting mindset, let's step back. There are three big accounting statements, right? There's an income statement, there's a balance sheet, there's a statement of cash flows. Which do you think accountants treasure the most? All the IFRS, GAAP rules. Which of these three do you think gets the most emphasis from accountants? One of the accountants can help me out. Which of those three? Balance sheet. Accountants are the last people on earth who actually think balance sheets matter. They think that what they tell you as shareholders' equity, we actually look at. We'll talk about why balance sheets have become worthless. But let's take a step back and think about how accountants construct balance sheets. And I'm going to put you into the accounting mindset. As I go through it, I want you to think about what kind of mindset would lead you to do this. So let's take a typical accounting balance sheet and think about how things are recorded. I buy land, I build a factory, I have a physical asset. How do accountants record it? Help me out. What do you do? How do you record an asset like a building or and what's the value you show? What I invested on the factory. And as I track this asset over time, it seems to deplete, right? Because you claim that some of it is being lost in the depreciation. So physical assets are recorded at original cost net of this depreciation. So you see, that makes sense. Okay. If you have short-lived assets, inventory, receivables, presumably you haven't had them for 20 years, in which case you're in big trouble as a business. There, the recorded value is going to be much closer to the current market value, as opposed to a building that I bought in 1955. So you can see two classes of assets. What if I make an investment in another company? How do you record it? How does an investment get recorded? Depends. So already you can see that when you look at a balance sheet, you have to know which pathway I took and what does it depend on? That'll define whether it's a majority or a minority holding, but let's say it's a minority holding. It's the amount I paid but even there's a branch. If I hold it for strategic reasons, if I hold it for trading reasons, like SoftBank holds it, what do I have to do? I have to mark to market. Already you can see that when you see a financial holding, an investment in another company on a balance sheet, how it's recorded is going to be very different depending on whether the accountants classified it for trading or for strategic reasons. So if you look at SoftBank had to do this incredible dance on WeWork. You know the sad story of WeWork, at least for Masasan, is he put a lot of money in WeWork and he priced it at 47 billion just before he pushed it to go public, expecting a big payday. And of course, 2 months into this, the whole thing fell apart. Not just the IPO, but the entire business fell apart because there was no real good business. I mean, what's the WeWork business model? What do they do? They rent spaces long-term, and then they sub-rent them or sublease them short-term. Historically, in real estate, you know why that model never works, right? All you need is one recession and you go bankrupt. It was a stupid business model, but with a lot of money behind it, including somebody who's viewed as an investing genius, Masasan. So, of course, the value melts down. And this is a problem for SoftBank because they'd recorded the investment at the $47 billion pricing, but because it was held for trading or viewed as held for trading, they had to mark it down. So in November, 2 months after the original, so in September, it's recorded at 47 billion. By November of 2019, they had to write it down to 8 billion. In fact, the only reason they stopped at 8 billion is an investor came in to WeWork after and priced it at 8 billion. Guess who the investor was? SoftBank. And the only reason they didn't, they want to go to zero. They delay the inevitable because now it's zero, right? So if you hold it for trading, you have this mark to market. In contrast, think about Yahoo in 2014. What was Yahoo's business in 2014? They had a search engine that nobody searched on. and an email program that only people over the age of 70 even knew existed. Basically, the basic business model had melted down because Google had eaten their lunch. So in 2014, I valued Yahoo's absolutely abysmal business model. And even with upbeat assumptions, I came up with a value of about 5 billion. Stock was trading at 39 billion. See, that is crazy. You know what I was missing in that valuation? Yahoo had two holdings that were not part of their operating assets. One was a 35% holding in Yahoo Japan. That's actually a standalone publicly traded company. And for some reason, the Japanese still seem to check for things on Yahoo. Don't ask me why. The other was a 21% holding of a company called, somebody want to fill in there? Alibaba. Just as it was about to go public at a $200 billion pricing. What's 21% of 200 billion? You don't even have to work out the math. A lot. But 40 billion, you know what it was recorded at on Yahoo's balance sheet? $500 million. Why? Because that was what they'd originally invested to get the 21%. Already you can see that when you look at an accounting balance sheet, depending on the item, it's a different set of rules. And then you get to intangibles. Let's step back from the accounting precipice. Do a lot of companies get a big chunk of the value from intangible assets? Have you looked at the list of the top 10 companies in the world in terms of market cap? First, what's the biggest company in the world right now in terms of market cap? Let's see how much you're keeping up with the times. It's Microsoft. $2.9 trillion. It used to be Apple, but during the course of the last few weeks, Microsoft has jumped to the top. Second is Apple. And then you can go down the list, right? It's Alpha. So as you go down the list, take a look at that list. And with each company, here's what I want you to do. Stop at the company. Say, where does this company's value come from? If you want, you can contrast with 1980, where the biggest companies in the world were manufacturing companies and financial service companies. We could point to things you could see. Tangible assets. And accountants have had an obsession with this intangible asset stuff for good reason, right? The big companies of the world get the bulk of their value from things you can't see. Where does Apple's value come from? Don't say brand name. That's lazy marketing lingo. First, it comes from the fact that they own their own operating system. I've lived with Mac OS almost all of my working life. And it gives them a differential advantage because they control the entire ecosystem. Styling, right? This is the only company that actually talks about styling and not only just means what it says, but actually spends money on it. It's not like Dell, where it says their version of styling is let's have Dells in different colors. Let's round out the edges a little bit. John Ive, Apple's designer, is legendary for thinking about styling and how it plays out. It's the operating system, it's styling. Maybe there's a component to know how you like the computer. But basically, almost every single, it's not a big plant in China that's driving. They have a Foxconn plant that they work, but that's not where the value comes from. It comes from things you can't see. Where does NVIDIA's value come from? AI, I guess, But, again, things you can't see, things that'll happen. My point is the big companies out there, the bulk of their value comes from intangible assets. So this is good, right? Accountants have finally woken up to the reality that they need to show intangible assets on the balance sheet. So last year, I valued a company called Birkenstock. What does Birkenstock do? Make incredibly ugly sandals that some people find really comfortable, right? That hippies wore and Kate Moss wore and Steve Jobs wore, so there's a celebrity buzz to it. It's a company with an incredible amount of intangibles. There's a brand name built up over 60 years of being in the right place at the right time, right? You can't recreate that. It also is a company where about 12 or 13 years ago, it was a family controlled company, a family owned company, where the family actually managed the company, but wasn't It was, it was founded in the late 1700s. So it's been around a long time. And by the early part of the century, that family was not, they were dysfunctional. They were not doing a good job. They had the good sense to actually bring in a couple of outsiders who turned out in hindsight to be incredibly good managers. Is great management an intangible? Absolutely. They found growth for the company. So you've got brand name, you've got great management. I told you about Kate Moss at the age of 16 wearing Birkenstock on a Vogue magazine cover in 1992. Steve Jobs wearing Birkenstock. Hippies wearing Birkenstocks. How much did Birkenstock pay these people to wear? So this is what makes Birkenstock special. They've never paid a celebrity. In a world where we pay YouTube, Mr. Beast gets paid $5 million to sponsor your product. Here you have a company, we have real celebrities, not made up celebrities, pushing your product, intangible. And then last summer, there was another intangible that got added to the mix. How many of you watched the Barbie movie? What's the connection to Birkenstock? Barbie wears pink Birkenstock in the movie. You didn't notice that, did you? Take a look, go back and watch the movie. She wears pink Birkenstock. And you know what happened last summer? There was a 30% jump in Birkenstock sales coming from the portion of a market where Birkenstock wasn't very strong. Young women who would normally not wear Birkenstock saw, the movie and they said, is that an intangible? Absolutely. So clearly so that I decided accountants must be claim they're dealing with intangible. Let me take a look at Birkenstock's balance sheet. I saw no brand name. I saw no great management. I definitely see a Barbie buzz in there. And then I said, maybe it's just Birkenstock. Let me look across all companies. So I took every publicly traded company. I took their balance sheets. I downloaded the data on intangible assets every year for the last 20 to see if intangibles are becoming a bigger part of the balance sheet. I'll give you the good news first if you want to defend accounting. The percentage of assets that come from intangible assets has about doubled over the last 20 years. You see, this is good. They're moving with the times. But here's the bad news. 88% of those intangibles came from one item. You know exactly which item it is, right? Goodwill, the most destructive and useless accounting item ever created. And let's talk about why. For Goodwill to manifest itself on a balance sheet. So I'm going to steer this discussion away from accountants. Everybody should know the answer to this. For Goodwill to manifest itself on a balance sheet, what does a company have to do? Let's not pass judgments yet, right? It has to do an acquisition. Already you can see why Goodwill is a meaningless asset, right? If I become the greatest company on the face of the earth and I never do an acquisition, there will be no Goodwill in the balance sheet. Take a look at Apple's balance sheet. There's almost no Goodwill. What was the last big acquisition that Apple did? I don't remember one. Already you can see Goodwill can't be measure what people claim it is if you have to do an acquisition. So now let me come back to you. You do an acquisition. Tell me how accountants compute Goodwill. What is the difference between? Okay, so what you pay uncontested, right? And if you take an accounting class and you get brainwashed enough, they'll say it's between what you pay and fair value. There's nothing fair about this value. It's book value dressed up. If any of you have been in a company that's been acquired after in an acquisition, after the acquisition, an accounting gang lands up in your company, Ernst & Young, Deloitte. And their job is to reassess the value of all your assets to attach a fair value. So 6 months and several $1 million later, here's what they've done. They've taken your asset value, they've finessed it a little bit. And I describe it as analogous to putting a coat on a turkey, right? Basically, you've got the scrawny neck. You're not going to be able to cover that no matter what you do. Dressing up a turkey still leaves it a turkey. It's book value dressed up, right? So basically, it's a difference. So if you paid $10 billion for a company and the book value dressed up is $4 billion, the accountant has a $6 billion problem to explain away.
right? Until yesterday. Why? Because until yesterday, you kept telling me it's worth 4 billion. Oh, oops, it's worth 10 billion. So they take the 6 billion, they call it Goodwill, they slap it in the balance sheet, and they do it for a very pragmatic reason. Why do we need Goodwill on balance sheets? Because balance sheets have this unpleasant requirement, which is they have to balance. Goodwill has only one reason for its existence. Without it, balance sheets would not balance. But there's nothing behind it. So every year I do send these suggestions to the accounting rule writers. They never seem to listen to them. So about 12 years ago, I sent a suggestion saying, let's rename Goodwill. Because it sounds good. And when it sounds good, people feel the urge to pay for it. I said, let's call it what it honestly is. Let's call it X. Not X as in Twitter, but now in algebra, you have two numbers that don't equate. If you want to make them equal, 2 plus X is, whatever. Because that's what it is. Because if you opened up a balance sheet, X is 17 billion, you wouldn't feel the urge to pay for it.
So accounting balance sheets, what you see as intangibles, bear no resemblance to what true intangible value is. On the other side of the balance sheet, if you look at accounting balance sheets, you'll see clutter. And that's the only way I can describe this, right? Every time and it's not the accountant's fault. Every time accounting rule writers sneeze, you get pneumonia as accountants because that's 7 additional line items. So they break debt down, current liabilities down, and 16 deferred items. And the older a company, the more populated your balance sheet becomes. And then, of course, they have this crowning glory of shareholders' equity, book value of equity. This is the accountant's entry into the competition of, hey, you don't like market value, use book value instead. But what goes into the book value of equity of a company? Let's say Coca-Cola. If I look at the book value of equity of Coca-Cola, what's in there? Just mathematically think through how I arrived at the number there. What goes in? First, if you go back in time, it includes the capital you raised in your IPO. When was that Coca-Cola? I don't know, a century ago. And it's a summation of every retained earning since. So mathematically, we are writing out book value of equity. It is the ultimate backward-looking number, right? It reflects everything you've done in your history. And that's a good point to stop and ask, what is the accounting mindset? The first is, it's record history. Good accounting should record history. In fact, I think fair value accounting distracts them from the reality. I need, from a corporate finance standpoint, to know how you got to where we are. Accountants are backward looking. They have to be. And when in doubt, you know what accountants do? They write more rules. They're rule driven. You don't believe me? Pick up IFRS, pick up GAAP. Just look at the rule number. You don't even try to read the rules. It'll drive you insane. Just look at the rule number. I still remember when they were doing the fair value accounting rules, they asked me whether I'd come in and talk to the accounting panel writing the rules. And I said, are you sure you've got the right guy? You know what I think about accountants? They said, no, come on in. Okay. So I said, can you send me the rule? This was 20 years ago. That you're thinking about constructing this, send me the rule. I said, FAS 157. You know what my reaction was? There are 156 other rules out there that I didn't even know about. But that's the nature of accounting. It's rule-driven and backward-looking. So if you have an accounting mindset, and not all accountants do, and some non-accountants have this mindset, here's what I want to do. I want you to switch it off. And here's the financial mindset. When I look at a company, I start with the accounting balance sheet. I have no choice, but I very quickly translate it into what I call a financial balance sheet. What does a financial balance sheet look like? On the surface, it looks like an accounting balance sheet. On the asset side of the balance sheet, there are only 2 items. Assets in place, investments you've already made as a company. That's pretty straightforward, right? So if I look at Microsoft, what's in here? Windows, Office, they own LinkedIn. No, that's in there. Things they've already done, assets in place. And growth assets, you're saying, what's in there? This is the value that I'm attaching to investments I expect you to make next year, 2 years out, 5 years out, 10 years out, 50 years out, forever. You're saying, that is crazy. Why would I do that? That's exactly what you do in markets. Why is NVIDIA valued at 1.5 trillion? It's not for what they're doing right now, but what is the promise that's driving it? You might think it's overvalued, but what's the promise that's pushing it up? the fact that it dominates the AI chip space, and that market is going to be a huge one, it's built it. That's what's in growth assets. When I presented this to a group of accountants, they said, that's subjective. They make it sound like a bad word. You know what? The future is always subjective unless you happen to have a direct line to God. And if you do, let me know. We'll cancel the class. We'll just let you tell us what's coming down the pike. It's subjective because it is the future. Yeah.
Talk about future investments.
No, this is investments that haven't even been specified. The company hasn't even thought about these investments. But take OpenAI, right? It's not even a company. It's a non-profit. It's one of the most absurd things I've ever seen. A non-profit valued at 80 billion. How the heck a non-profit gets valued at 80 billion? I don't want to wrap my head around it. But there's nothing there yet, right? No revenues, no earnings. They haven't thought about the project, but the idea is they have the platform that if AI takes off, you might be able to make money. How? I don't know. But you bring it into the value, and we do it in markets all the time. Could we be wrong? Absolutely. But that doesn't mean they don't have value. You can't take the position of, if it's uncertain, I'm going to attach a value 0, because that is a value. I'll wager that my estimate of value for AI is going to be better than 0. Growth assets capture the value of things that you might do in the future, which you don't even know about. And on the other side of the balance sheet, there are only 2 ways you can fund a business: private or public, small or large. You can borrow the money or use your own money. So if it's a startup, your own money is the equity. Borrowed money can come from friends, relatives, until you have no more friends and no more relatives. And then it becomes, it can come from a bank. Debt and equity. It's a much cleaner way to think about businesses. In fact, I'm going to use that as a platform to talk a little bit about some differences across companies. But now let me lay out the big picture of corporate finance. I'm going to make a confession. There's going to be lots of details over the course of this class, which you might or might not get. Hopefully you get it enough to get through the class. How to estimate betas, hurdle rates, returns on capital. But I'll be quite honest. I don't care if you forget all of that stuff the week after your final exam. Don't do it the week before. That might be a little unfortunate. If you remember this page, this is corporate finance on one page. I truly mean it. If you get this page, you got corporate finance. So as I go through this page, here's what I want you to think about. Even if you've never taken a corporate finance class, you've never worked in finance, corporate finance is basically about 3 big groups of decisions that every business has to make. The first decision is the investment decision. Here's the principle in corporate finance. Corporate finance is principle-driven and forward-looking. Unlike accounting, which is rule-driven and backward-looking, here's the principle in corporate finance. It governs how you think about an investment. You want to make that investment if you can earn a return on that investment that exceeds some minimum acceptable hurdle rate. That sounds like a buzzword, right? For the moment it is, but I'll give you the sub-principle that's going to govern how we think about hurdle rates. The hurdle rate for an investment should be higher for riskier investments and lower for safer investments. Does that make sense to you? Did you need finance to know that? That's best common sense. It should also reflect where you get the money. Remember, you can borrow the money or raise your own money. That makes sure. So the hurdle rate should reflect the risk in the investment and the mix of funding used for that investment. Of course, for the moment, you're saying, how do we measure risk? That's why we have 25 more sessions, right? We'll fill in the details. But that principle still holds. And when we talk about returns in finance, those returns should be based on cash flows as opposed to accounting earnings, right? All that time you spend in the accounting class talking about FASB rules and GAAP earnings, I couldn't care less. Ultimately, I care about cash in, cash out. So I'll have to justify that because all that work seems to be thrown to the wayside. Should reflect when you get the cash flows. Let me ask you a common sense question that I had to ask all of my kids at the age of 4 or 5 to figure out whether to set aside money for college for them. So when they were 5, they'd get allowances every Saturday. So one Monday ahead of the Saturday allowance,
So this is at different points in time because my kids go from, 34 to 24. So basically across when they got to the age of 4 or 5. I would ask the question, do you want to wait till Saturday or do you want to get your allowance today? A consequential question. Because if they'd said, I'd like to wait till Saturday, I would have pulled the money out of the college fund and said, you know what, let's create a McDonald's fund for you, right? And you can go work. Because it's common sense. I knew I was in trouble with my youngest when he said, Dad, is it the same allowance? That's deep finance, right? He's thinking present value. You might not, see, you don't need to do a present value equation. In Latin America, they never talk about present value because you come out of your mother's womb understanding that a peso today is worth more than a peso a year from now. Bolivar today is definitely worth more than a Bolivar later today. Time value, you just learn that you want. So if you're talking about return, should reflect based on cash flows, reflect when you get those cash flows, and should have all side effects built into it. There's no garnishing allowed in investment analysis. You think, what are you talking about? Many of you worked at companies, or before you came in, right? How many of you worked at traditional companies rather than banks or consulting companies? Okay. So let's suppose you had a project analysis you did in a company, and the numbers tell you shouldn't take the investment. But there's somebody in the room who really, 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 really wants to take the investment. You know what's going to happen, right? Buzzwords are going to come up, but there are strategic reasons. And now, of course, with this horrendous nonsense about ESG, and I won't hold back. It's one of the, if you can create a concept that's both toxic and empty, ESG's managed to pull it off. That's kind of a tough thing to do. I'm going to say terrible things about ESG. So if it's going to hurt you, bring some earplugs because it is going to come at you. There are ESG considerations. Make our ESG score go up. This is garnishing. You're using buzzwords to override your number crunching. Your job is to bring it into the numbers. You want to talk strategic? Let's talk strategic. What is it that you see that's strategic? And I'm going to try to bring it into the numbers. So return should be based on cash flow, should reflect the timing of the cash flows, should have all of this other stuff, the good stuff that you see out there in the numbers. The second principle is the financing principle. The financing principle says, I told you there were 2 ways you could raise money for your business, debt and equity. That the right mix of debt and equity for your business is the one that maximizes your value, minimizes your hurdle rate. You'd rather have a lower hurdle rate than a higher one, I hope. So if you can find a mix that reduces your hurdle rate, go for it. That's it. And if you ask me, what kind of debt should I take? You know what I mean by what kind? Long-term or short-term? Dollar or euro? Fixed rate? I mean, we have, in terms of choices, so many different choices. I'm going to turn the question back on you and say, tell me what a typical investment looks like for your company, and I'll tell you what the right kind of debt for your company is. You are an Indonesian infrastructure company. Your debt should be long-term Indonesian rupiah debt. I don't have to do dances around this. Why? Because your projects are long-term, your debt should be long-term, your cash flows are in Indonesian rupiah, your debt should be in. I know you can think about exceptions, but this is the core principle. If you're going to break it, then you either have to have a really good reason or get protection when you break it. That's a financing principle. Find the mix of debt and equity that minimizes your hurdle rate, match the debt up to your assets. Then I turn to the dividend principle. The dividend principle says if you cannot find investments that make your hurdle rate, for God's sake, don't force the issue and say, this is the best I can do. My hurdle rate is 9%, but I can't make more than 7.5%. There is a better choice, which is take the money out of the business. If it's a private business, give the cash back. There's no glory in growth for the sake of growth, investing for the sake of investing. And this is one of my problems with that other buzzword you probably heard in a lot of your classes, which is sustainability. I understand climates, sustaining the planet. I understand sustaining a product. I just don't understand sustaining a company.
I don't understand why you would do it. Companies are legal entities. If the reason for your existence is gone, please leave. With GE every day, I say, please, God, put it out of its misery. It's a zombie company at this point in time. There's no reason you should be sustaining a company if your purpose is gone. The dividend policy says if you cannot find investment to make your hurdle rate, give the cash back. It's a private business. It's your cash. Take it out. If it's a public company, it's a little messier. You have to return cash to shareholders. And you have two ways of doing it. One is the traditional way, which is pay dividends, which is what for a century and a half companies have done. The other is to buy back stock. And I know there's all this noise about stock buybacks. Bernie Sanders doesn't like it. And in fact, last year's, I think, or the law that was passed 2 years ago specifically targeted companies doing buybacks. We can come back and talk about bad reasons for doing buybacks, but buybacks are just flexible dividends. And they're directed at people who want to cash out. And if you ask me which one should I use, I'm going to argue that whether you should return your cash in dividends or buybacks depends on who your shareholders are. If you're Con Ed, what does Con Ed do? Supplies power for this building and much of New York. It's a regulated utility, historically held by shareholders who like dividends. If you have a lot of cash, what should you do? Pay dividends. If you're Google, you've never paid a dividend in your life, you have a lot of cash, what should you do? Buy back stock. I told you corporate finance. The rest of this class is icing on this cake, right? You've got it. This is corporate finance. And in doing all of this, you have a central objective in corporate finance, which in the last 20 years has come under assault. The central objective in corporate finance is you want to maximize the value of your business. So I'm going to use that big picture to lay out a few broad themes for this class. The first is any of the stuff that I told you in that big picture something you didn't know already? Because what did I say? If you can raise money at 8% instead of 9%, please raise it at 8%. Massive insight? No, you knew that already, right? And if you raise it at 8%, don't go take projects at 6%. I knew that already. Why should that surprise you? Corporate finance at its core is common sense. We've added a lot of stuff to that common sense, given you more tools, but at its core, it's common sense. You know how old corporate finance is as a discipline? It can be traced back to a paper written in 1958 by two professors at the University of Chicago then, Merton Miller and Franco Modigliani, 1958. You're saying, what happened before 58? Corporate finance was just glorified accounting. Thank God it's not 1955. I wouldn't be teaching this class. 1958 is when corporate finance is born. Have people been running businesses for way longer? Well, I'm sure there were some very good cave business people. Imagine new tools for sale, fire, disruptive force. You can now no longer live in the darkness. Good business people through the ages have always understood these first principles. India's largest company in terms of market cap, a company called Reliance, founded by a man called Dhirubhai Ambani. You know where he got his MBA? He was a 5th grade dropout. But he got these first principles. Trying to convince Dhirubhai Ambani to invest at 7% when the hurdle rate was 9%, you'd be fired if you tried to do that. I don't care where you got your MBA. So here's what I want you to do. As we go through this class and we talk about doing something and it doesn't make sense to you, no matter, don't let the fact that I said it intimidate you. I want you to stop and say, that doesn't make sense to me. Because if it doesn't make sense, something is not gelling. Either I'm selling you snake oil, or there's a piece of the puzzle you're not seeing, because ultimately everything in corporate finance has to be traced back to common sense. Oops. Second theme, corporate finance is focus. You know what I mean by focus? We're pretty clear about how to pick projects. We're saying you should go out and pick a project if its net present value is positive. We're categorical. There's no on the one hand, on the other hand, on the third hand. There's no fuzziness here. And you know where that focus comes from? It comes from having that singular objective. The reason we have that focus is because we have this objective of maximizing the value of the business. And therein lies corporate finance's weakest link. And here's why. If you disagree with that core objective, everything in corporate finance falls apart. So you know what? We're going to spend about 3 sessions talking about that objective, and I'm going to let you bring in everything you have as a counter objective, including maximizing ESG, maximizing sustainability, maximizing market share. You throw it at me because I want that out of the way before we talk about, because if you don't know where you're going, it doesn't matter how you get there. Without an end game, we're lost. So there's focus, but the focus comes from this very specific objective. So I'm going to spend a lot of time not just defending it. I'm actually going to do something weird. I'm going to take the objective and look at its weakest assumptions. I'm going to take it apart because I want to immunize you. Because in your other classes, you're going to see people use, oh, corporate finance, Milton Friedman people, you know, they maximize value. They're not in the 21st century. It's absolute nonsense, but I want to give you the tools so you can see where that comes from. My 14th book is going to get published this year, sometime this year. It's amazing how much of a lead time there is. October of 2022, I turned in the page proofs. August of 2024, the book might hit the bookstores. What are you doing for 2 years? Finessing the font. I mean, basically, they do all these weird things, right? They spend all this time doing stuff. You say, what's wrong with you, right? But the book is about what has become one of my favorite structures in all of my classes. It's a notion of a corporate life cycle. We all know what the human life cycle looks like, right? You're born, you're a baby, toddler, teenager, peak of your life. You know what the peak of your life feels like? For some of you might still be there. It's when you can go to bed at 3, wake up at 6, and be a fully functioning human being. That doesn't last very long. Enjoy it while it lasts. And then you know what's coming, right? So let's take a business. In business, what looks like, what's the equivalent of a baby? Startups, right? They need constant care and attention and capital, unlike a baby. So think of capital like mother's milk. You know, every 2 hours you get up and cry, I need another 10 million, another 20 million. And it all comes out very quickly. So you have to go through this whole process over and over again. After the babydom, you come to toddlers. And what do toddlers do? They fall, they get up, they fall, they get up, they fall, and sometimes don't get up. And startups do the same thing. They become toddlers. And after the toddler years come the teenage years. Some of you not that separated from that time, but I've had 4 kids who've gone through those years. And you know what every teenager does, right? He or she gets up in the morning, looks in the mirror and says, I have lots of potential. What can I do today to screw it all up? That's a teenage mindset. Time horizon of what, 15 seconds. This is why you can get into Harvard. And what do? You then put up this social media page, a post that's so stupid that that offer is withdrawn. And you think, what were you thinking? You weren't. You're a teenager. When I bought Tesla for the first time in 2019, I'm getting very close to buying it again. In 2019, I described it as my corporate teenager. Does Tesla have lots of potential? Absolutely. Even if you don't buy into the company, it's got incredible potential. But one man gets up every morning and he says, what can I do today to screw it all up? Maybe I'll tweet about a Thai diver. What are you thinking? Maybe I'll buy a couple of $1 billion in Bitcoin. Why? But I said, look, if you're buying Tesla, stop complaining about Elon Musk because it comes as a package. It's a corporate teenager. Then you reach the peak of your life. I told you what it looks like for human beings, but for companies, the peak of your life is everything you touch turns to gold. Now, whether you remember, 2016, Google and Facebook could do no wrong. Shows you how quickly things can pass, but everything they touched turned to gold. Mark Zuckerberg was a genius. Enjoy the peak of your life, because after the peak of your life, what's coming? Middle age.
My daughter's going to turn 30 in a year, and she's already dreading it. She says, life is over. What am I going to do? I'm going to be middle-aged. Nobody gets up and says, I want to be middle-aged. But it's coming, right? And while you moan about the fact that you're middle-aged, enjoy middle age, because even worse things are coming later. Because after middle age comes old age, and after old age comes dementia, and after dementia comes death. And companies go through the cycle as well. I'm going to argue that almost everything in corporate finance can be framed through the life cycle. What are the big three decisions? The investing decision, the financing, and the dividend, right? Let's take this out. I know we've not done the class. Let's say you have a startup. Where is all this value coming from? The future. Does the investing decision matter? It's the only thing that matters. Let's keep going. I said there are two ways you can raise money. Debt and equity. How much should a startup borrow? 100%. You want to go bankrupt? What's the rule in holes? When you're in a hole, stop digging. What's the nature of a startup? They're already losing money. It is beyond absurd for a startup to borrow money. This whole notion of venture debt, just putting my brain around, I mean, even figuring out what that means. Now, we'll talk about what drives it. It's one of those strange bubble-driven phenomena. We expect VCs to pay your interest expenses. That's what venture debt is. It should never exist, in my view. But lots of things that happen in finance shouldn't exist. So a startup should borrow no money. Why? Because to make interest payments, you got to make money. You're not making money. So what the heck are you doing borrowing money? You're saying, I have no choice. Maybe that's the reason. You get pushed into a corner. But if you have a choice, it should be it. And how much dividends should a startup pay? Nothing. Your negative cash flows. You've done it, corporate finance. Investing principles is all that matters. I've said being the CFO of a startup is like being the janitor in the company. Nobody cares what you do. You're in the basement with the janitor. Maybe the janitor does more than you do. They keep the floors clean. Nobody's going to say, what should our dividends be this year? Can you tell us how much we should borrow? As you age, assuming you age, remember there's a very high mortality rate for corporate. What percentage of startups don't make it to year two? 2/3, 67% of startups don't make it to year two. That's in good times. In bad times, it could be even higher. If you make it through, hopefully what's happening, you're scaling up and you're starting to make money. Unless you're one of the startups from the last decade where venture capitalists forgot to ask the second question. How do you plan to make money? They thought about scaling up, scale up. Oh, by the way, how do we make money? I don't know, but let's keep scaling up. This is the Airbnb and the Uber model, right? Make yourself a giant before you figure out what your business model is. But presumably, if you're a healthy company, at some point in time, you start to make money. And when you start to make money, initially, you might still choose not to borrow. But there, you can see that as you go through the life cycle, there will be a time where your capacity to borrow money will open up. Your capacity to pay dividend. You tell me where your company is in the life cycle. I can tell you how corporate finance principles are going to play out in that. Fourth, it's universal. In fact, it's unfortunate that this class is called corporate finance. Because what is a corporate? Send a signal, message about that what we're going to talk about over the next 15 weeks applies to companies. That if you're a small business, it doesn't apply to you. Do you think that hot dog stand, that guy's been the hot dog stand outside, that guy's been there for 32 years. The guy runs that stand. I've grown old with him. I know where his kids went to school. Does that guy have to make investment decisions? When he added sausage to the menu, initially he used to sell hot dogs alone. That was a big investment decision for him. He had to carry an extra. And about 20 years ago, he used to be in a stand where he was outside the stand. Even in winter, he'd be wearing all this. And then one day he showed up, this was 20 years ago, and he's got the stand and he's inside the stand. I said, this is good. And he said, it cost me a lot. It cost him $40,000. Big investment decision, huge. How do you think he raised the money? He borrowed some. He didn't do a debt to equity optimization. He had to choose a funding mix. And does he care about dividends? He has 3 kids. They went off to college. Guess who's paying for them? The dividends from the hot dog stand. Investment decision, financing decision, dividend decision. I'm going to argue that he will pay a bigger price for screwing up on those decisions than International Harvester would or Coca-Cola would, because they're too big to fail. They can go to capital markets. He is not too big to fail. He can't go to capital markets. So if he screws up on an investment decision, he goes bankrupt. So everything we say in this class will apply across all companies, small or large, public or private, emerging market or developed. There's no separate corporate finance for Australian companies or natural resource companies. So next class, when we start, I'm going to talk about the companies I'm going to use, and I'm going to get you started on your project. And here's what the first job you have is. You have to find a group. The group can be between 4 and 8 people. And I will not put you in a group, but I will create an orphaned list if you have trouble. You don't want to be on this list if you can avoid it, but I will wait till Friday. And if you have trouble finding a group, I'll put in the orphaned list and you will get adopted by a group, hopefully. But try to find a group between now and Wednesday. Hey, how are you?